December 2024. While families celebrated the holidays, something terrifying was happening in the gold markets that nobody saw coming. A single technical indicator that's predicted every major gold crash for the past 50 years just flashed red for the first time since 2011. But here's the thing. This isn't your typical "gold is going to crash" video where some YouTuber throws around random predictions. What I'm about to show you comes from the same technical analysis that called the 1980 crash, the 2008 collapse, and the brutal 2011-2016 bear market that wiped out $1.2 trillion in gold wealth. But get this, the crash signal isn't coming from where you think. Because while everyone's obsessing over inflation data and Fed policy, the real danger is hiding in plain sight in a place that's about to shock the precious metals world. Stay tuned, because what happens next could determine whether you protect your wealth or lose everything in the coming gold apocalypse. Right now, gold bugs around the world are celebrating. And who can blame them? Gold hit an all-time high of $2,790 per ounce in October 2024. Investment newsletters are screaming about $5,000 gold. Precious metals dealers can't keep coins in stock. YouTube is flooded with channels promising gold will hit $10,000 per ounce. The euphoria is intoxicating. After years of being mocked as gold bugs, precious metals investors finally feel vindicated. Central banks are buying gold at record levels. Geopolitical tensions are through the roof. The dollar is supposedly collapsing. Everything seems perfect for gold. But that's exactly when the most devastating crashes happen. Let me show you something that should terrify every gold investor. This is the exact same pattern we saw in 1980, right before gold crashed 65%. The same setup we witnessed in 2011 before the brutal 5-year bear market that destroyed fortunes. Mass euphoria, record buying, mainstream media coverage, then silence. The crash of 1980 was legendary for all the wrong reasons. Gold peaked at $850 per ounce in January, equivalent to about $3,000 in today's money. Within 18 months, it had collapsed to $300. Investors who bought at the top didn't see their money back for over 25 years. 2011 was just as brutal. Gold peaked at $1,921 and then entered a grinding bear market. By December 2015, it had fallen to $1,050, a 45% decline that lasted 5 agonizing years. But here's what's different this time. The crash signal isn't coming from the usual suspects. While gold investors focus on inflation, central banks, and geopolitical chaos, the real threat is building in the shadows of the financial system. It's something so subtle that even experienced traders are missing it. I'm talking about the $26 trillion corporate bond market. And what's happening there will make your head spin. But before we get to that bombshell, you need to understand just how dangerous the current gold euphoria really is. The warning signs are everywhere, but they're being drowned out by the noise of record prices and mainstream media hysteria. Let me tell you about my friend Mike. He's been buying gold for 15 years. Smart guy, successful business owner, always careful with his investments. In October 2024, when gold hit those record highs, Mike made the biggest precious metals purchase of his life. $300,000 in gold coins and bars. "This is it," he told me over dinner. "The dollar's collapsing. Gold's going to $5,000. I'm finally going to be rich." I tried to warn him about what I was seeing in the technical indicators. He wouldn't listen. "You don't understand," he said. "This time is different." Those 4 words, "this time is different," are the most dangerous in investing. They're the same words people said in 1980, the same words they said in 2011. And they're the same words Mike will remember when the crash comes. Here's what Mike didn't know, what almost nobody knows. The corporate bond market is sending a signal that should terrify every gold investor. But it's so technical, so buried in financial jargon, that mainstream media completely ignores it. Investment-grade corporate bonds are showing the widest spreads to treasuries since March 2020. Translation? Corporate America is getting more expensive to finance, even though the economy supposedly looks strong. But wait, it gets worse. High-yield corporate bonds, the risky stuff, are starting to crack. Default rates are climbing. Companies that loaded up on cheap debt during the COVID era are struggling to refinance at higher rates. Now here's the kicker that changes everything. When corporate bonds crash, institutional investors don't buy gold. They do the exact opposite. And what they do next will shock you. But first, let me show you the technical analysis that's been screaming warnings for months, while everyone was celebrating record gold prices. There's a secret indicator that most gold investors have never heard of. It's called the gold-silver ratio, and it's been the most reliable predictor of precious metals crashes for over half a century. Here's how it works. When the ratio hits extreme levels above 80, it signals that gold is overbought and silver is oversold. This imbalance creates massive pressure for a correction. Look at this chart. In 1980, right before the crash, the gold-silver ratio hit 99. In 2020, before the COVID correction, it spiked to 125. And guess what happened in September 2024? The ratio touched 88, the highest level since the pandemic crash. But that's just the beginning. The real danger signal comes from something called the Commitment of Traders report. Data that reveals what the smart money is actually doing while retail investors pile in. Large speculators, the hedge funds and institutional traders, have built the largest net short position in gold futures since 2018. While your neighbor is buying gold coins at the coin shop, the professionals are betting on a crash. Commercial hedgers, who represent actual gold producers and users, have their largest net short position in over 2 years. These are the people who actually understand the gold market, and they're positioned for a major decline. But here's what kept me up at night, researching this story. Remember that $26 trillion corporate bond market I mentioned? Here's the connection that changes everything. When corporate bonds crash, and they're showing all the signs of an impending crash, institutional investors face massive redemptions. Pension funds, insurance companies, and mutual funds suddenly need cash. Fast. And where do they get that cash? They don't buy gold. They sell everything liquid to raise dollars. This exact scenario played out in 2008. As corporate bonds collapsed, institutional investors dumped gold along with everything else. Gold fell from 1,030 to 680, a 34% crash in just 4 months. The same thing happened in March 2020. Corporate bonds crashed, and gold fell 12% in 3 weeks despite massive money printing and global panic. Here's the brutal truth. In a real financial crisis, gold doesn't act like a safe haven. It acts like a risk asset that gets sold to raise cash. But the corporate bond crisis is just one part of the story. The real danger comes from something even more sinister, and it's happening right now. While gold bugs celebrate the death of the dollar, they're missing the most important financial development of 2024. The dollar is actually getting stronger, not weaker, and it's happening in a way that will devastate gold prices. Here's something that will blow your mind. Despite all the talk about de-dollarization, dollar usage in global trade has actually increased in 2024. It now represents 88% of all foreign exchange transactions, the highest level in 5 years. Central banks might be buying gold, but they're still conducting business in dollars. Russia and China can talk all they want about alternative currencies. But when push comes to shove, they still need dollars for international trade. The Federal Reserve has created the ultimate trap for gold investors. By keeping interest rates elevated, they've made dollar-denominated assets incredibly attractive. Why own gold that pays no interest when you can get 5% on Treasury bills? Remember my friend Mike? 2 weeks after our dinner conversation, something happened that made him question everything. His business partner, who's been in international trade for 30 years, told him something that chilled him to the bone. Despite all the headlines about countries abandoning the dollar, his company's overseas suppliers are actually demanding more dollar payments, not fewer. The dollar shortage is getting worse, not better. His partner explained. When crisis hits, everyone wants dollars. Mike started to realize that maybe, just maybe, he'd been reading the wrong signals. While retail investors pour money into gold ETFs and coin dealers, something sinister is happening in the institutional world. The smart money is quietly heading for the exits. GLD, the world's largest gold ETF, has seen outflows of $2.8 billion in the past 6 months. That's not retail investors selling. That's institutions reducing their positions while retail piles in at the top. Even more telling, gold mining stocks are underperforming gold itself by the widest margin in 3 years. When the companies that actually produce gold can't keep up with the metal's price, it's a classic sign of a bubble top. Hedge funds that specialize in precious metals are quietly raising cash positions to their highest levels since 2019. They're preparing for something, and it's not good news for gold bugs. But the institutional exodus is just the warm-up act. The main event, the catalyst that will trigger the crash, is something most investors don't even know exists. The crash won't come from where you expect. It won't be a Fed announcement or an inflation report. The trigger will be something called a liquidity crisis in the overnight repo markets. Here's how it works. When financial stress hits, banks stop lending to each other overnight. This creates a cash shortage that forces everyone, including gold investors, to sell assets to meet margin calls and redemptions. Think of it like a game of musical chairs. When the music stops, when liquidity dries up, everyone scrambles for cash. Gold becomes just another asset to sell, not a safe haven to buy. The repo market is already showing stress. Overnight rates are becoming more volatile. The Federal Reserve has quietly increased their overnight repo operations by 40% in the past 3 months. These are not random events. They're warning signs that the financial system is becoming less stable, not more stable. And here's the part that should terrify every gold investor. When the liquidity crisis hits, it won't just crash gold prices. It will expose a massive fraud in the precious metals market that will shake investor confidence for years. The paper gold scandal. Nobody discusses. The gold market isn't what you think it is. For every ounce of physical gold that exists, there are estimated to be 100 to 200 ounces of paper gold. ETFs, futures contracts, and other derivatives that claim to represent gold but don't actually hold the metal. This works fine when everyone's happy and prices are rising. But when panic hits and investors demand physical delivery, the system collapses. We saw this in March 2020. The price of physical gold coins and bars skyrocketed to $200 per ounce, while paper gold traded at $1,600. The disconnect was so severe that dealers stopped selling entirely. But 2020 was just a preview. The next crisis will be far worse because the paper gold system has grown even larger while physical supply has actually decreased. Central banks might be buying gold, but they're buying from other central banks, not from new production. Mining output has been flat for 5 years, while paper gold derivatives have exploded. What happens when millions of gold ETF investors try to convert their shares to physical metal and discover there isn't enough gold to go around? The smart money's exit strategy. While retail investors buy gold at record prices, the smart money has a completely different strategy. They're not buying gold. They're not even selling gold. They're shorting gold mining stocks. Here's why. Mining stocks typically fall faster than gold itself during a crash. In 2008, while gold fell 34%, the average mining stock fell 70%. In 2011 to 2016, gold fell 45%, but mining stocks fell an average of 80%. The smart money knows that when the crash comes, mining stocks will be the first casualties. They carry all the risks of gold prices plus operational risks, debt burdens, and equity market volatility. Hedge funds have built record short positions in major mining stocks. They're betting not just on lower gold prices, but on the complete destruction of mining stock valuations. But when will this crash actually happen? The technical analysis gives us some clues that might surprise you. The timeline of destruction, based on historical patterns and current technical indicators, the gold crash will likely unfold in 3 phases over the next 12-18 months. Phase 1, the false dawn, next 3 to 6 months. Gold continues to hover near record highs, while smart money quietly exits. Retail investment continues to pour in. Mainstream media celebrates new records. This is the distribution phase where institutions sell to retail investors. Phase 2, the break, 6 to 12 months. A liquidity crisis in corporate bonds or overnight markets triggers the first major sell-off. Gold falls 20 to 30% in weeks. Retail investors buy the dip, thinking it's a temporary correction. This is the trap that catches the most victims. Phase 3, the capitulation, 12 to 18 months. The paper gold system breaks down completely. ETF redemptions trigger forced selling. Physical premiums explode while paper prices collapse. Gold falls 50 to 60% from its peaks. Only then does the real buying opportunity emerge. I called Mike last week to check on his $300,000 gold position. His voice was different, quieter, more uncertain. "I'm starting to see what you meant," he admitted. "The technical indicators you showed me. They're getting worse, aren't they?" I didn't have the heart to tell him that based on historical patterns, he was likely looking at a $150,000 loss over the next 18 months. How to protect yourself and profit from the coming crash. Here's what you need to know to survive the coming gold crash and maybe even profit from it. First, if you own gold, don't panic sell, but don't buy more at these levels. The crash will create amazing buying opportunities, but we're not there yet. Second, if you're thinking about buying gold, wait. The crash will give you the same ounces for 40 to 60% less money within 18 months. Third, consider shorting gold mining stocks through inverse ETFs or put options. This is how the smart money is positioning for the crash. Fourth, build cash positions now. When the crash comes, cash will be king. You'll be able to buy assets at fire sale prices while everyone else is forced to sell. The choice is yours. You can follow the herd into gold at record prices and watch your wealth evaporate over the next 18 months. Or you can position yourself like the smart money and profit from the crash that's coming. But remember, in investing, timing is everything. The crash signals are flashing red right now. By the time mainstream media catches on, it will be too late. What's your take on this? Are you positioned for the gold crash, or are you still buying at these levels? Drop a comment below and let me know your strategy. If this analysis opened your eyes to the real risks in the gold market, hit that like button and subscribe to FinSight Capital. We expose the financial truths that Wall Street doesn't want you to know. And if you think this gold crash prediction was shocking, wait until you see what we're covering next. The commercial real estate collapse that's about to make 2008 look like a warm-up. Click here to watch it now. This one will blow your mind. The gold crash is coming. The only question is whether you'll be ready for it. Remember, the best investors aren't the ones who follow the crowd. They're the ones who see the crash coming before everyone else. Don't be like Mike. Be like the smart money. Your financial future depends on it.